Hello, and welcome to the Wade Borth podcast. I'm your host, Wade Borth, and in every episode, my goal is to get you to think differently about how money works and ultimately to empower you to take control of your money and your personal financing system. Hello, and welcome back to the Wade Borth podcast. Today, we're going to continue our conversation about some of the takeaways I had from the Nelson Nash Institute, the think tank that they hold once a year. This year it was down in, I always tell people it was in Henderson, Nevada. It was not in Las Vegas. And anymore, you can't tell the difference, but just a small difference there. But we were actually in Henderson, Nevada. We had nearly 300 people in the room, which is fabulous to see. It's one of the largest crowds I can remember in a long time. So it was fun to have a lot of new people there. And if you're new and you happen to be listening to my podcast and you're a practitioner, make sure you're working with a great mentor. Find somebody that fits your values. So anyhow, my recordings, just going back to the NNI, the think tank, it was said from stage, and I want to share a story with you. I had a client ask me a couple weeks ago. He says, Wade, I've been looking at this IBC idea, this idea of controlling your own banking. So he'd read Nelson's book. He'd done a lot of studying. He was pretty sharp on this whole idea. But he was caught. He was almost like he was perplexed because he didn't know where to go. And I said, well, I use Bob. I said, Bob, what's the holdup? What's holding you back from implementing this? What is it you want from this? And he understands it completely, but he got caught in this trap, this revolving trap around, well, which product should I buy? Which product should I buy? Which product should I buy? And I said, well, Bob, I said, quite frankly, it's not a product problem. It's a human problem. We have to get over the human problem first. And so, and he appreciated that, and he goes, oh, I see that. But he said, so if I get down to it, which product or which instrument should I be using? I said, hey, that's a great question. So we talked about it, and I said, well, how does anybody that understands the difference between whole life and universal life, let's talk about that real quick. Whole life is you are a owner of the insurance company and a participating whole life policy. You get the benefits of how the company is being ran. In a universal life, you are just a customer of the insurance company. They put a product out there. It's like going to the bank. They give you 3% on your CD, and that's what you get. And so think about what position you want to be in. That's the first difference. Second difference is whole life is the only product that can guarantee that what you want to happen will happen at the right time. Now, everybody's going to come back and say, well, wait, universal life and whole life, they're all considered permanent products. I said, well, yeah, I think that's the way they're classified, but Nelson talks a lot about misclassification. I really believe that universal life is not necessarily permanent. I was actually even down at Cal College, and they've changed their definition. They used to call it PLI, permanent life insurance. And they don't even say permanent life insurance anymore because they represent a lot of IUL companies. They call it cash value life insurance. And so the fact that they're changing the name on this thing must tell you that IUL is not, it can be, but it's not guaranteed to be. That's the big difference. And so, because what's happened is that they've transferred risk, and they've transferred the risk over to the owner of the policy, the insured, and now it's out of the insurance company's hands. Now think about what an insurance company does. It manages risk. That's what an insurance company does really well. You know, they manage risk. And so these policies will do exactly what whole life policies will do. At the very minimum, I know what it's going to be. And so when we think about it, why do I want whole life over IUL or UL or VUL or whatever it might be? I'm not saying those aren't the products you want for infinite banking. And quite frankly, I don't think that's the product you want if you want a death benefit either. The reason I say that is, again, what I'm saying is that they transfer risk. What do I mean by that? They do a great job of putting out these huge projections. Like this is going to have, some of them are really silly projections too. But what if it doesn't happen that way? What happens if it doesn't happen that way? And when life doesn't happen exactly like it's laid out, then the question is, what are you going to do about it? And so the idea of having a policy that's not going to fulfill the need that it's designed to do is scary to me, because you don't find the results of that until you're 30, 40, 50 years down the road. And I'm speaking from experience. I agreed to service a book of business and help clients understand this before it's too late. And what I mean by that is that there's a book of universal life business that was sold when interest rates were 12 and 14%. And even the most conservative illustrations at that time, they were doing 8% or 6%. Well, now they're all the way down to 4% or 4.5%, whatever their guarantee was. And the things are still lapsing at age 85, 86, 87, 88, right before the person dies. And one client says, well, I paid the premium for the last 35 years. I'm like, yep, you did. But the problem is that it didn't meet the assumptions. And so what it did, it transferred that risk that really nobody understands, except for if you're a pricing actuary and you can reprice that and you can run the calculations and the numbers every year. You have to run that every year and have to make some assumptions, right? So that's the whole problem. You have to make assumptions to make these things work. So that's why UL is not, in my mind, is not a great product. It leaves that risk up to the client that has no idea how to manage that risk. No agent knows how to manage that risk. And so it puts a burden on the client to do something that they're not equipped to do. I'm not making this out like, hey, you can't do something, but we don't know how to even run those calculations. What's the long-term calculation of, instead of hitting 8% one year, we hit 2, or we hit a 0. We don't go backwards. According to them, we don't go backwards. Well, we do, because the cost of insurance still has to come out. But the point is that you have this policy that, what if it hits a 0? What if it hits, and you say, well, it's going to average 8%. Well, hey, that might be true, but an average is a linear thing. The death benefit and the cost of insurance is an exponential thing. And when the exponential curve passes the linear curve, that's when this policy is going to lapse. So what I mean by that is, in the short term, it doesn't look like it has much of an impact at all. Oh, we're $3,000 shorter in our cash value. No big deal. Until that compound effect of that $3,000 shortage shows up 20 years later. And now the policy is ready to lapse because there's not enough cash in the policy. Even though you might have averaged that 8% they're going to tell you you're going to do. I mean, that's the scary part. They'll do an average or they'll backdate, or that's as silly as anything, right? I'm going to look in the rearview mirror to drive forward. That's what they're saying. Hey, we're going to back this thing 20 years. And they just make it up as they go. And they say, well, we're going to create the perfect scenario going backwards. And if you want to take that risk, then go ahead and take that risk. But all I'm saying is, you're taking risk in running your business, running your life, financing the things that you want. Why do you want to take additional risk that's really unseen? It's really unmanageable and unseen in your IUL, versus taking a product that's designed to guarantee to be there. Is the cash value going to be exactly the same year 10, 15, 20, 30 years from now? Absolutely not. I'm not saying that. I'm saying a worst case scenario, a whole life, I know what the cash value is going to be. I know what the exit strategy is going to be for that cash value, or for that policy. If I need it to get the money or I die, I know what the exit strategy is. I think I know what the exit strategy is for IUL, because they put these rose-colored glasses on me to show me this illustration. So I think I know where that's going to go. A good friend of mine, and you probably heard me say this before on the podcast, Tracy McManaman, he used the phrase, and I told him I'm going to steal it because I love it so much. He says, I want to be in the I know business versus the I think business. We're running our family financing system. Heck, we're even buying death benefit for buy-sell for a business, for key person, for protect your family, whatever it is. Do you want to be in the I think business? Because again, you're making a decision today that you won't see the impact, hopefully 20, 30, 50 years from now. When you start stretching out that time frame that long, what's going to happen? I think is going to have a lot of wiggle room. Like, it might be there, it might not be. And you don't see it at the very beginning. It's like flying from LA to New York. If you're just 1% off flying from LA to New York, you end up somewhere in Vermont, right? But you don't see it flying over Arizona. You don't see it flying over Nebraska. It starts to show its ugly head at the end. And that's really the problem with IUL versus whole life. We don't know. We don't know what the impact of not hitting those returns year 7, 8, 9, 10 are until you get to be age 80, 85, 90 years old. The day before you die is if your policy lapsed the day before you die, how great was the return that you got in it? It really wasn't worth a dang thing. So go back to the I know product. Again, the IUL to me is just, it's a product of a company for customers, where the whole life is a product for the owners of the company. And think who's more accountable, if you're selling product to the general public or you're selling product to your owner. So think about it from that standpoint. If you agree, disagree, let me know. I'd like to have that conversation, because again, I've seen and I've experienced those type of policies from, again, owning myself, because when I first got in the business, I didn't know what I didn't know, right? So we all grow in understanding and know what we're doing. And just ask me, I'll tell you how I've seen an impact. People that have paid their premium for 30 or 40 years, not that I sold, but other people have sold. And again, I'm not casting blame on the agent. I'm casting blame on everybody that was involved in that transaction, the insurance company, the agent, the client, because they all wanted something. And when it didn't deliver, then they're all sitting in a circle pointing fingers at each other. But again, that doesn't show its ugly head until the end, right? Until you're 85 years old, uninsurable, can't get another policy. And then, I'm coming in and say, oh, by the way, for that $1 million of coverage, you got to put in $250,000 to save this contract. Oops. That's a hard discussion to have. So anyhow, I would just say, when you look at your policies, when you look at doing infinite banking, don't get enamored by rates of return. Don't get enamored by impressive illustrations, because Nelson said it to us many times in his book. In person, he told me, he says, illustrations are just lies and more lies. Even the whole life illustrations aren't true after the day after you have your policy. It's not true, because your cash value is going to be a little bit more, a little bit less. So don't depend on that. Just understand that it has a guarantee, and even the guarantee is a lie from the standpoint that it's probably, he knows that it's going to be more cash in there than what it's saying, because the insurance company is already designed to issue a dividend after the end of your first policy. And that illustration on the guaranteed side assumes no dividends ever. But even if there's no dividends ever, I know what the very least is. I know what the very least is on that policy. Go back to IUL and say, well, if there's zero interest paid in the whole of this contract for the next 40 years, how does it do? Is it designed correctly? So take that. Love to have your conversation on this. Share this video, like it, you comment on it. Love to see what people are saying. Reach out to us. Go to sagewellstrategy.com or wade@sagewellstrategy.com and take a look at the content we put out there, because this content is around how to empower you to become the best that you can be, and really finding that freedom and control you're looking for by owning that financing function in your life, right? Take everybody else's decision-making out of it, and you be the one that's in control. You're going to be the one that's in the driver's seat, and you get to decide if you want to run it to the red line or you want to run it high RPMs. But again, running anything at a red line all the time is a very dangerous thing. So we want to make sure that we're using it wisely and invoking counsel. Come, if you're working with me, having a conversation with me, how does this work? What should we be doing? Having some strategy sessions, or whoever you're working with, make sure that you involve those people that have an understanding and knowledge of how to use these things. Because again, the tool isn't what makes the craftsman. It's the knowledge and understanding of how to use the tool. That's what makes a craftsman. Thank you for your time. If you're enjoying this podcast or know anyone else that might be interested, please be sure to hit the subscribe button and please leave a review. This will help this podcast reach and help more people by ranking higher in searches, and ultimately help more people get out of financial bondage. And don't be afraid to share this podcast with your friends and family, as we can be easily found on Apple Podcasts and Spotify.